If you were to look at a checklist for building a really prosperous, resilient country.
Right, like the ideal economic foundation.
Exactly. Canada basically has every single box ticked in thick green marker. I mean, you've got abundant natural resources literally across the board.
Oh, absolutely. Energy, minerals, agriculture, you name it.
Check. A highly educated workforce. Check. A remarkably stable financial system that, traditionally weathers global storms way better than most. Check.
Mm.
So looking at those fundamentals, you would naturally assume their economic engine is just, well, purring along.
You would. But the macroeconomic dashboard has actually been flashing warning lights for quite some time now.
Right, and it's a massive economic paradox. Let's look at the historical data for a second. Back in 1981, Canada's real GDP per capita was 94% of the American level. They were practically neck and neck.
Yeah, almost at parity in terms of living standards.
Exactly. If an American was making $100, a Canadian was making 94. But by 2023, that number had plummeted to around 75%. Wow.
Yeah. That is a steady, decades-long slide in relative prosperity. And it touches everything, from household debt to public infrastructure.
And to really understand why that happened, we have to look past the obvious surface-level metrics. We have to examine the invisible forces that shape how businesses invest, how they compete, and, well, how they survive in a globalized world.
Which brings us to our mission for today. We are doing a deep dive into this, frankly, massive April 2026 macroeconomic analysis.
Right, from the Global Review.
Yes, by Fareed Novin. And it makes this really compelling, almost counterintuitive argument. We are going to unpack how Canada's most celebrated economic tool, its flexible exchange rate, might actually be this, structural sedative.
A structural sedative. I love that term.
Right, one that has been quietly dragging down its prosperity. And we'll explore how the intense 2025 to 2026 tariff war with the U.S. essentially just blew the lid off this long-standing issue. It is a fascinating paper. I mean, it takes something that seems incredibly dry on the surface, exchange rate regimes, and shows how it literally dictates the destiny of an entire nation.
I have to admit, I really didn't think I'd get this excited about monetary policy.
It sneaks up on you.
It really does. But, whether you are actively tracking global markets, or maybe you're running a cross-border business, or you just love a good economic mystery, this deep dive reveals how the very safety nets designed to protect an economy can sometimes be the exact thing slowly suffocating it.
Exactly.
But before we get to the current crisis, we have to understand why Canadian policymakers fell in love with their exchange rate model in the first place.
Right, because you have to go back to a time when floating your currency was actually considered economic heresy.
Exactly. So picture this. The year is 1950. The world is operating under the Bretton Woods system.
Right, the post-war order.
Yeah. This was an era where currencies were rigidly fixed to the U.S. dollar, which was tied to gold. Predictability was the ultimate goal for international trade. But then the Korean War breaks out.
And that triggers this massive global commodity boom. Suddenly, the entire world desperately needs Canadian resources. Wheat, metals, timber, all of it.
Capital is just flooding into Canada. And under a fixed exchange rate, the Bank of Canada had to basically absorb all that incoming cash.
Because they had to maintain the peg.
Right. So more money chasing the same amount of domestic goods means prices skyrocket. The result, inflation spiked to over 10%. So Canada did something really radical. They became a pioneer.
They abandoned the fixed parity.
Exactly. They abandoned it and floated the Canadian dollar.
They essentially let the global market decide its value based purely on supply and demand. And, well, it would work beautifully in that specific context.
It really did.
By 1952, inflation had dropped back down to under 3%. The floating rate absorbed the external shock of that huge capital influx, which protected the domestic economy from runaway prices.
Now, they eventually fixed it again in 1962, but they floated it permanently in 1970, which, fun fact, actually preceded the famous Nixon shock that formally ended Bretton Woods entirely.
Oh, that's right. They were ahead of the curve.
They were, and they did it for similar reasons. You had this massive U.S. inflation from the Vietnam War and the Great Society programs, and it was just spilling over the Canadian border.
And the final piece of the puzzle really falls into place a bit later, in 1991.
Right. The Bank of Canada paired this floating exchange rate with a strict 1% to 3% inflation target, aiming right at that 2% mark.
Which is the modern standard.
Exactly. And this combination created what economists affectionately call the shock absorber model. The idea is when global oil prices drop, the Canadian dollar depreciates. That makes Canadian exports cheaper abroad, cushioning the blow for manufacturers.
Okay, let's unpack this.
Yeah, let's get into the mechanics. I like to think of this floating exchange rate like the suspension system on a really high-end mountain bike. You are the domestic economy riding over the rough terrain of the global market.
Okay, I can picture that.
Right. So when you hit a massive boulder like a crash in global oil prices, the suspension compresses. The exchange rate drops. The bike absorbs the jolt, so the rider doesn't get thrown over the handlebars into a painful deflationary recession.
What's fascinating here is that while your mountain bike analogy is perfectly illustrating the intent of the policy, history showed us really early on that a suspension system doesn't actually steer the bike.
Right. You still need a good rider.
Exactly. In the late 1950s, during that very first floating period, there was this event known as the Coin Affair.
Ah, named after James Coyne, right. The Bank of Canada governor at the time.
That's him. Under his leadership, monetary policy became highly restrictive. Coyne aggressively raised interest rates. Now, because he raised interest rates, foreign capital flooded into Canada to chase those high yields.
Because investors love a high return.
Exactly. And under a floating system, that massive influx of foreign cash forced the value of the Canadian dollar artificially high.
And a hyperinflated currency is absolutely brutal for anyone trying to sell goods outside the country.
Precisely. That artificially high dollar immediately crushed Canadian exporters. It caused an economic slowdown and a really sharp rise in unemployment.
Ouch.
Yeah. The Coin Affair proved that a floating rate is not self-stabilizing. It's really just a neutral mechanism. It amplifies the virtues of good central banking, sure, but it equally amplifies the damage of errors.
Right, so the bike suspension works, but if the rider actively steers into a ditch...
You're still in a ditch.
Exactly, which brings us to the core of our modern paradox. If this suspension system works so beautifully to absorb global shocks, why is the Canadian economy currently falling so far behind the U.S.?
It's the million-dollar question.
Because the answer, according to the source material, is that the shock absorber inadvertently turned into a hammock.
A structural sedative, as the author calls it.
Let's talk about the commodity supercycle. This was from roughly 2002 to 2014. Global demand for natural resources just explodes, largely driven by China's rapid industrialization at the time.
Right.
Oil prices surge by an incredible 600%. And because Canada is a major energy exporter, all that incoming resource wealth pushes the Canadian dollar way up, actually to parity with the U.S. dollar.
And this triggers a very classic economic phenomenon known as Dutch disease.
Right, the Netherlands.
Yeah, the term comes from the Netherlands in the 1960s when they discovered North Sea natural gas. The massive influx of revenue drove up their currency, which suddenly made all their other exports, like their traditional manufacturing, way too expensive for the rest of the world to buy.
And in Canada, the results of that were stark. The manufacturing sector's share of the GDP fell from 18% down to about 11%. It just hollowed out the industrial heartland.
It really did.
And our source notes the intense political debate this caused back then. You had Thomas Mulcair, the federal NDP leader, loudly arguing that the oil sands in the West were actively hollowing out central Canada's manufacturing base.
While on the other side, Mark Carney, who was the Bank of Canada governor at the time, countered that the manufacturing decline was actually a broad, long-term structural trend happening across all advanced economies, not just a symptom of the strong petrodollar.
Right. But, regardless of who was more right in that specific debate, the aftermath of that supercycle reveals a terrifying productivity gap. Listen to this. From 1981 to 2024, U.S. labor productivity grew by over 127%.
And Canada's
labor productivity grew by only 61%.
That is, wow. And that gap isn't just some abstract number on a spreadsheet. It represents real wages, real innovation, and ultimately, real living standards.
Now, here is the crucial mechanism the paper identifies: the weak currency bias. When the commodity boom eventually ended and oil prices fell, the Canadian dollar depreciated significantly. It dropped down to around 73, 74 U.S. cents and just sort of stayed there for years.
And this is exactly where the shock absorber becomes a trap. Because when the Canadian dollar is weak, domestic firms that are actually very uncompetitive can still somehow survive.
How does that work, though?
Because their products are artificially cheaper in the U.S. market just because of the exchange rate.
Ah, so it acts as an untargeted, invisible subsidy.
Precisely. In a healthy economy, you want what we call creative destruction. You actually want inefficient firms to fail so that labor and capital can move to innovative, highly productive firms. But the weak currency protects those inefficient companies. It keeps them on life support.
Now, wait a second. I have to push back on this premise for a second, because if you talk to anyone in the export business, they will tell you a weak dollar is an absolute lifeline. Isn't a weak currency a good thing for exporters? Doesn't it mean they sell more products to the U.S. and keep Canadians employed?
This raises an important question, and you are absolutely right about the immediate short-term effect.
Right.
The exporter makes the sale, the factory stays open, the payroll gets met. It feels like a win. But the paper argues that this is actually a long-term poison
Oh, so.
because it completely removes the incentive to innovate. Think about what a Canadian zombie firm actually looks like compared to an innovative U.S. competitor. Let's say you have a factory in Ontario making auto parts and a factory in Ohio making the exact same parts.
Yeah, I'm visualizing it.
The Ohio factory is facing fierce domestic competition, so the owner invests heavily in robotics, AI-driven logistics, and upskilling their workers. They essentially double their output per hour.
And what about the Ontario factory?
Well, the Ontario factory owner.
Yeah.
Their profit margins are magically protected by a weak 73-cent dollar. Their parts are 27% cheaper in the U.S. before they even turn the factory lights on.
Wow.
So they just don't feel the burning need to invest in that expensive new automation. They just keep doing what they're doing with outdated equipment. Over a decade, that Ohio factory becomes vastly more productive, while the Canadian factory just stagnates.
And there is a second, even more damaging layer to this dynamic that the source brings up. To become more productive, companies actually need to buy that advanced machinery, those robots, and that specialized software. Well, Canada imports about half of its machinery and equipment from the United States.
Exactly. So a weak Canadian dollar makes the very tools required for modernization astronomically expensive.
It's a brutal catch-22. I mean, the weak dollar keeps you in business today because your exports are cheap, but it makes the tools you absolutely need to survive tomorrow entirely too expensive to buy.
It really is.
Yeah.
And when you combine that weak currency complacency with Canada's heavy reliance on small firms, which generally just have lower productivity than large ones, and its heavily sheltered oligopolies in sectors like telecommunications and banking, you have a recipe for severe long-term stagnation. There's just not enough competitive pressure forcing these companies to evolve.
So this underlying sickness, this reliance on a weak currency to sort of hide terrible productivity, was quietly simmering for a decade. But then came a massive geopolitical stress test that exposed the whole system, the 2025 to 2026 tariff war.
Right. This was the moment that theoretical vulnerabilities became a very painful reality.
Let's lay out the facts impartially here, as documented in the source. In February 2025, the Trump administration imposed sweeping tariffs, 25% on most Canadian goods and 10% on energy exports.
Lots of.
And Canada immediately responded with its own retaliatory tariffs on billions of dollars of U.S. goods.
This was an external shock of just massive proportions, and it completely destroyed the illusion that Canada has total monetary sovereignty.
Because to cushion the domestic economy from the tariff shock, the Bank of Canada had to aggressively cut interest rates, bringing them way down to 2.5%. But south of the border, the U.S. Federal Reserve was fighting its own battles and holding their rates high in the 4 to 4.25% range.
That is a massive interest rate differential between two incredibly integrated economies.
Huge. And money is smart, right? Investors see they can get a much higher, safer return in the U.S., so capital naturally flees Canada. This massive outflow crashes the Canadian dollar to near two-decade lows, hitting around 71 U.S. cents by late 2025.
Now, under the old shock absorber theory from the 1990s, this deep depreciation is supposed to help. It's supposed to make Canadian exports so incredibly cheap that it magically offsets the cost of the 25% tariff at the border.
But the reality on the ground was a nightmare. This time, the depreciation weaponized imported inflation. If you're listening to this and you live in Canada, you felt this instantly.
Oh, every day.
Yeah. If you buy fresh groceries in the winter, or auto parts, or if you run a small business relying on U.S.-priced software subscriptions, a 71-cent dollar means your daily costs just skyrocketed. It made life incredibly expensive for Canadian households that were already heavily squeezed by debt, and the sheer uncertainty of the trade war effectively froze foreign direct investment.
Right. Nobody wants to invest when the rules of the game are changing daily.
Exactly. Here's where it gets really interesting. The paper calls this dynamic a constrained float. I picture it like walking a dog on a bungee cord.
Okay, I like this analogy. Let's hear it.
So the Bank of Canada is the dog. They have the freedom to wander away from the U.S. Federal Reserve's path. They can cut rates to 2.5% while the U.S. stays at 4%. But the further they stray, the tighter that bungee cord gets.
Right.
The currency drops, imported inflation spikes, everything gets expensive, and eventually that cord violently snaps them back. They aren't truly independent.
That is a highly accurate way to visualize it. And we have to look at the geopolitical angle here, too, which makes the bungee cord even more dangerous. In the modern era of strategic trade policy, a depreciating currency isn't just an internal spreadsheet metric.
Right. How does Washington see it?
Well, when trading partners look at a currency that is persistently dropping, they don't always see natural market forces at work. They often view it as a deliberate competitive devaluation.
Ah.
They see a country trying to unfairly cheapen its exports to get around tariffs, and ironically, that perception invites even more retaliatory tariffs.
So the shock absorber is essentially broken at this point. It's causing as many problems as it's solving. Which brings us to the fork in the road. The tariff shock proved Canada can no longer rely on its old playbook. So according to the analysis, what are the equilibrium paths forward?
The paper outlines two very distinct paths. The first is what we can call the low-growth trap.
This is sort of the path of least resistance, right? Canada basically does nothing. They continue to tolerate the weak dollar, letting it subsidize unproductive firms, and avoid the painful friction of economic restructuring.
But the long-term cost of that comfort is staggering. The paper actually cites a McKinsey prediction stating that if this low productivity trajectory continues, Canadian households will be $16,000 worse off annually by 2035 compared to a high-growth scenario.
$16,000 a year per household.
It's huge.
That is the invisible tax of low productivity. Let that sink in. That's not just a rounding error. That's a family losing the ability to save for a down payment on a house or constantly choosing between basic groceries and necessary expenses. Real wages will stagnate, and the standard of living will visibly decline relative to the U.S.
Which leads us to path two, the high productivity transition. This requires deliberately withdrawing the currency subsidy. You force firms to innovate or fail.
And we are seeing signals that policymakers recognize this, thankfully. The source notes the Carney government's 2025 budget, which committed $110 billion over 5 years, specifically targeted at innovation and emerging technologies.
Right. It's a massive pivot toward capital deepening.
And for those unfamiliar, capital deepening just means giving workers better tools, more robots, better software, advanced machinery, so that each hour of human labor produces vastly more value.
Exactly. But to really force this transition, the paper proposes two radical policy choices regarding the currency regime itself.
Let's hear them.
The first option is an enhanced floating regime. You keep the floating exchange rate, but you aggressively target that capital deepening. You introduce massive tax incentives for research and development. You actively smash the sheltered oligopolies in telecom and banking to force competition. And crucially, you finally tear down interprovincial trade barriers.
Ah, right. It's wild to think about, but regulations between Canadian provinces essentially make it harder for a business in Alberta to trade with a business in Ontario than it is to trade with a foreign nation.
It's crazy.
Yeah, tearing those down actively forces domestic competition. You make the internal economy so fiercely competitive that firms have to innovate regardless of where the dollar is at.
Exactly. But the second option, this is the one that really shakes up the status quo. The credibility-anchored fixed regime. Essentially, abandoning the float entirely and pegging the Canadian dollar directly to the U.S. dollar.
So what does this all mean? Hold on, wouldn't fixing the currency to the U.S. dollar mean giving up Canada's monetary sovereignty entirely?
Well,
I mean, the Bank of Canada would just be importing U.S. inflation and mirroring whatever the Federal Reserve decides to do. Isn't that exactly the straitjacket Canada fought so hard to escape back in 1950?
if we connect this to the bigger picture, the paper argues that the idea of Canadian monetary sovereignty is largely an illusion anyway, because supply chains are so deeply integrated, as we saw with the tariff shock. Canada is already importing U.S. inflation. The bungee cord is already pulling them.
Okay, that's a fair point. If you buy mostly American-made goods and American-priced commodities, your inflation is tied to theirs no matter what your central bank does.
Exactly. By formally pegging the Canadian dollar to the U.S. dollar, you eliminate the weak currency bias overnight. Suddenly, a Canadian manufacturer can't rely on a 73-cent dollar to make their goods cheap in Chicago.
Right.
They have to compete purely on the quality of their product, the efficiency of their factory, and the brilliance of their innovation.
It imposes a brutal but necessary structural discipline. It forces creative destruction. You either automate, innovate, and get better, or you go out of business.
It replaces the comfort of the shock absorber with the discipline of a hard constraint. It would be an incredibly painful transition in the short term. I mean, there would be firm closures and job losses in inefficient sectors,
Mm.
but it might be the only way to shock the entire system into genuine high-value productivity growth over the long term.
It is the ultimate economic tough love. And that brings us to the end of our deep dive into Fareed Novin's 2026 analysis. The story of Canada's economy over the last 75 years is essentially a cautionary tale about the danger of comfort.
It really is. The mechanisms designed to shield the economy from volatility ended up shielding it from the very competitive pressures required for long-term growth.
And it's a lesson that scales, right? Whether you are managing your own household budget, investing your portfolio in the stock market, or running a multinational company, relying on external buffers like a weak currency or a lack of competition or an artificially protected market instead of focusing on internal improvement and true efficiency, it eventually leads to stagnation. Growth, real, sustainable growth, almost always requires the painful friction of creative destruction.
You have to expose yourself to the elements to learn how to build a stronger house.
Beautifully put. So as we wrap up, I want to leave you with a lingering thought to chew on. If Canada's world-famous macroeconomic shock absorber inadvertently became a sedative that stifled an entire nation's innovation for decades, it makes you wonder, what other safety nets in our own careers, our businesses, or our governments are secretly keeping us comfortable today at the terrible cost of our prosperity tomorrow?
It's a question we all need to be asking.
Thank you so much for joining us on this exploration of the sources. We will catch you on the next deep dive.